Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so we have exciting talk today about regional banks and commercial office space. There is a ridiculous amount of loans out at regional banks. I want you to guess in the comments what dollar amount that you think the regional banks have out just in office space. That's all we're talking about, office, not industrial, not retail, not any residential or business loans, just office space, office buildings, okay? Nationwide, regional banks, not Chase and the big banks, right? Okay, but before we get in, while you're doing that, we're going to talk about something super exciting. Juana tomorrow gets to go on stage in front of a massive group of people at a real estate conference in Vegas to promote, because she's been asked to promote Referral Cloud and tell all these agents what Referral Cloud is. Juana, you were the CEO and co-founder of Referral Cloud. What the heck is it? Like, what does it do for real estate agents?
That makes me sound so important.
It is super. You're like the boss. You're like the Elon Musk of referrals for real estate agents.
There you go. But I'm not fighting, what's his name?
You're not fighting. You're not cage fighting.
No, I'm not cage fighting.
Zuckerberg.
No. Okay, so Referral Cloud, it's a platform for real estate agents to transact their referrals, their agent-to-agent referrals. So if you're an agent, you are looking for an agent in another market because you're selling your client's house and they're moving to another market, you go on Referral Cloud and you either put your client's information there and have us assign the agent for you, or you can go on there and choose an agent of your choice on there. It's really cool. The agents get to put all their information on there, their bios, what languages they speak, their markets, their specialties, all that good stuff, so that it's so much better than Facebook, right? Because now you get some information about those agents, and then you get to track the whole transaction in Referral Cloud, so there's accountability because you can have your conversations in there, and when it's all said and done, hopefully your client closes with the referral agent, and then you get paid your referral fee. It's pretty awesome.
What else do they get? They get something more than just a referral fee. That's the magic.
Okay, so you get bonus time, right? So the bonus time, not only do you get paid your referral fee, but then when there is somebody coming into your market, you get a referral back. But you don't necessarily get it from the agent that you picked, for example, in Massachusetts. Maybe you get the referral from somebody in Texas or someplace else, because the idea is this is a clearinghouse for agent-to-agent referrals, and you get rewarded for using the platform.
Yep, and there's an iPhone app. You just type in Referral Cloud, and you fill out your information, and you can start getting referrals. But you have to put your referrals through the app,
right,
if you want to get that referrals back.
Right.
You're not going to get them back if you don't put referrals in.
Right. And then if you have already sent out referrals, this is a good way for you to track the referrals you've already sent out. So you know how that black hole that you just signed the referral agreement, you send it off and then you never hear from anybody again? Let's put an end to that. Let's get some accountability going. Let's get some transparency going. Put your referrals in there. Invite that agent to Referral Cloud too, and then you guys can have your conversations in there, and then you can keep track of your referrals. Look, your clients are treasure, so treat them like that. Make sure that you are keeping track of what's happening with that referral and that you get paid at the end.
All right. Okay, on to regional banks. Here's the magic number. Regional U.S. banks have surprisingly large exposure to troubled $2.9 trillion office loan sector. Jerome Powell. That is a bunch of zeros. That's 11 zeros. That's a 2, a 9, and then 11 zeros with 4 commas. That's a lot. That's a bunch. That's a big number. Okay. Before we go into the data of why, let's start with big, huge banks. Big, huge banks aren't really doing office spaces. Like Goldman Sachs doesn't loan somebody in Topeka money because they want to put up an office complex.
Right, generally not. And remember, a lot of these loans also have SBA loans attached to them. So these are pretty complex transactions.
Okay.
But the small and the regional banks, they're the ones that generally do this sort of business. And they're the ones that have all this exposure. So there is a concern, obviously, that we're going to see a lot more of this domino effect, like we saw a couple months ago with Silicon Valley Bank and other banks. And I think that is certainly something that the Fed is watching closely. My hope, honestly, is that the Fed is more proactive, and that maybe there's some encouragement for some consolidation of some of the banks that maybe have less exposure with banks that have more exposure, so that so all this can be better mitigated. There are a lot of banks. There are about 600 banks in this position right now, so that's a lot of banks. There's a lot of opportunity there to maybe restructure things a little bit, maybe consolidate, maybe have some of the larger banks consolidate some of these smaller banks and then absorb them, and then use the assets of the larger bank to balance those portfolios. I think that there are a lot of opportunities to do good things, and I'm hoping that the Fed seizes that opportunity and encourages some sort of action that helps these banks survive, maybe not in their present form, but helps these banks survive and safeguards the deposits of their customers.
Okay, so here's the ultimate concern. The banks say, "Holy cow, we're getting killed on these office loans we made. The bank is gonna go belly up, and you know what? We can't pay the depositors' deposits back." And then the Fed comes in and has to backstop everybody $250 or $500,000. And then if you have $3 million in your regional bank, you're like, "But what about me?" Right? You're out. And this always gets called a bank bailout, but it's not a bank bailout. It's customers getting bailed out. The bank never gets bailed. The bank shareholders get wiped out. The people who run the bank get wiped out. Everyone gets wiped out. But the depositors are made whole. Now, we're going to talk about a bit about how these banks and why they do these loans, and then we'll talk about how this affects residential, because Elon Musk said this thing, put out this tweet that literally said, "Hey, these regional banks are going to hit with this office thing, and then it's going to spill over into residential." And that it doesn't actually work that way. It's not like you drop a bomb on the bridge and you miss the bridge and it hits the hospital, at the end of the bridge, and the bomb blows up it's not like, "Oh, we're going to take out this regional bank. Let's just take out the housing market in Topeka while we're at it."
Okay. So I think it's kind of the opposite.
Okay.
So what happened with, during the pandemic, what happened when people couldn't make their mortgage payments? Their servicers were encouraged very strongly to work with them and make things work. One of the things that they did is they stretched out mortgages to up to 40 years, right? So that was one of the accommodations that they did in order to help the borrowers stay on track and be able to stay in their homes. Well, that is a possibility for some of these commercial office building loans. What if the bank said, "You know what? We know that we haven't done this in the past, but these are extraordinary circumstances, so here's what we're going to do. We're going to go ahead and we're going to extend your loan or do some sort of accommodation the same way that they did on the residential side." So rather than having commercial spill into residential, what if commercial takes a page out of the residential book and applies it to commercial in order to mitigate what's happening in that sector? It doesn't have to be for very long. It just has to be long enough to give these borrowers time to refinance again. So I think that is a possibility. I think the Fed can encourage that. I just think that there are more options than what has been put out there. I think everybody's been very rigid about this is the way we do things. And what we learned with the pandemic is that we don't have to be rigid. We can be creative, and we can do things that make business sense for everybody.
The problem is these banks. This is not, "Hey, 4% of our loans are delinquent, so we'll just give them some time." This is like most of these regional banks that are in trouble. They need this cash. They have to have those people that own those office buildings pay them, because they have to take those payments and pay other people, and they don't have the money to pay other people.
Right.
They're running out of cash. If they don't get the money, they can't pay depositors, and as soon as somebody says, goes on Twitter and says, hey, the regional bank of Topeka is, told me I couldn't take out my, $1 million, that they're restricting withdrawals to only 100,000. Everybody and their mother is going to run down the bank of Topeka, even if they have 250,000 in there, and they're going to pull their money out. I want my money, and then there's a run on the bank. I literally think this is, we're in a day and age where people can find out this information, and you just know that some local news person is going to go on the news and go, now we just talked to so-and-so, and he said he pulled all his money out of Bank Topeka because he heard the bank was going into business, and next thing you know, I'm sorry if there's a bank at Topeka, I just made it up, but that's how this stuff happens. I don't know that you can do this, because I'm going to show you this next slide.
I think you can. I think you can. You can do workouts with these borrowers the same way you did workouts with a residential, and make it work. I understand that it's a far greater portion of their portfolio, but the assumption at that point is that everybody is in trouble, and not every borrower is in trouble. But if you can take care of the ones that are in trouble, and if you can get to the ones that are not in trouble but will be down the road, and deal with them on the front end, I think you can definitely not eliminate, obviously, all the problems, but you can certainly make the problems not be quite as bad.
Here's the problem. I'm going to read this quote first.
Okay.
According to a recent report from Goldman Sachs, small and mid-sized banks hold 67.2% of all outstanding commercial real estate loans. That's a huge percentage. They're not...
Yes.
Okay, here's the problem. You're a bank.
What size bank am I?
You're a medium-sized bank.
Thank you.
You need cash because you happen to have over-leveraged yourself. You're one of the 600 banks that have over-leveraged yourselves in office space. Mm-hmm. It got hot. A bunch of people came in, built these office buildings, and you've got 40 or 50 office buildings you're getting no money from, and it's a huge, you were told you were going to be Silicon Valley, version 3.0, mm-hmm. and it didn't happen because of the pandemic and work from home. So now you're like, holy cow, we need cash. And the people come to you and go, hey, look, we don't want to lose our investment because we ain't put money down to buy this thing. So we don't want to make payment for 3 years because we don't have any tenants. And after 3 years, we'll figure it out. The banks are almost better off to say, we're foreclosing, we'll sell it. We know that it's probably worth, this one building's probably worth 30 million. We'll take 15 now and because we need the money. We can't, yes, we're going to lose money in the long run, but our problem is the bank is not you, in 5 years. Our problem is us now. So either we get some money now, or that's going to be the problem, I think. I think these banks are going to say we need the money, and it's just like the one who the bank had to agree to the sale to sell the $200 million building for $60 million or whatever the number was in San Francisco, because the bank was the one taking loss.
Right.
The bank had to agree to extinguish all the loans, fine. It was a $300 million building. They sold it for $60 million. Someone owns it for $60 million. Now it's an empty building. It's not even, Pride doesn't even power on it. And the bank had to take the loss.
Right.
It was a regional bank.
Right. But what I'm saying is there are tenants who say, hey, I know that I have to refinance my loan because I've got a balloon payment coming up.
Right.
Rather than refinancing, just extend my loan. I'm making my payments. I just can't afford to refinance. And those are the borrowers that I'm talking about. Not every borrower is delinquent.
I know.
And what I'm saying is there are borrowers who are not delinquent, who the bank can work with, and that's what I'm suggesting.
Yeah.
The other thing is, kind of to your point, if you're maybe a Goldman Sachs, you're kind of sitting there waiting for things to implode and then coming in and getting a bargain. And that's another thing. So there are lots of moving pieces. It'll be interesting to see how creative the Fed gets. I think there's an opportunity there. I'm not saying there's an opportunity for every bank, but I'm saying that I think there's an opportunity there for certain banks in certain situations to make things better and to save those banks, because remember, community banks are really important. They serve a very important role in communities, and it would be really unfortunate to have a vast number of them disappear. It harms the consumer in the end, and that's part of what the Fed needs to do, is to put programs in place to help these banks survive, and because that benefits consumers in the end.
Let's talk about the spillover to residential.
Okay.
regional banks and small local banks tend to not go out and try to compete with massive mortgage companies that can get and JP Morgan Chase and huge banks that have these huge systems in place to just crank through underwriting and package these loans and sell them. Regional banks aren't interested in your trying to get you a loan at whatever the prevailing rate is. Like it's very credit unions can, but it's a lot harder for these regional banks. They just tend to not do it.
Well, they tend to not do it, and they're generally not that competitive, so that they're not going to have a large portfolio of residential loans. They will probably have some. But okay, so let's say that they have some residential loans. What does that mean? Not a whole lot. Because if the bank stays in business, you keep making your payment. If the bank is no longer in business, you still keep making your payment.
You still keep making your payment.
So that really doesn't impact residential in that way. It does impact residential, kind of to your point, because sometimes these banks do have special programs, particularly maybe in smaller communities or underserved communities, and they do these loans, which just kind of goes back to the earlier point that I made, that it is worth the Fed's time and effort to find ways to help these banks survive so that they can keep servicing those communities. And that might mean some residential loans, whatever that means in those communities. But as far as having a negative effect on residential, only in the sense that you may have less choices, particularly in smaller communities. So yes, it does spill over in that way, but not in a way that has anything to do with property values.
Regional banks having problems does not negatively affect real estate. There is this misbelief that it was the banks failing that collapsed real estate. Absolutely not. We were watching real estate values tank and foreclosures balloon before anything happened to banks. It was the opposite. What happened was all these subprime loans were being classified as AAA paper and being sold and resold and credit default swaps and all this other stuff, and they weren't worth anything. They were upside down, and people were trading this, giving people loans based on, they were trading this A paper that wasn't A paper, and that's not happening now. It's not happening now. So there's literally zero chance that anything that happens with office could somehow spill in to residential.
Right, except for the part of having less choice. Yes, that's correct.
Yeah, but less choices it's the amount of choice is very small. I mean, it's like you do have choice. Just go to a mortgage lender. Go to Rocket Mortgage or or JP Morgan or just get a bank, a national bank.
Right.
It's just not Wells Fargo. They won't give you a loan anymore because it's so competitive. The mortgage companies are doing so well that Wells Fargo doesn't even want to compete.
Right.
They just said, hey, we're not going. They were the number 2 for many years, home mortgage company, Wells Fargo Home Mortgage, and they just said, nah, we're not going. Just portfolio clients from now on.
Okay. So interesting what's going on with the office space and with small and medium regional banks. What do you think is going to happen? Drop us a note and tell us what your thoughts are. We appreciate hearing from you. Please let us know where you're watching from. Please be kind to one another in the comments.
Please wish Juana good luck being on massive stage tomorrow in front of millions of real estate agents.
Oh my gosh. Nothing like, never mind.
Okay. There won't be millions. I heard there's only a couple 100,000 actually. There.
Anyway, please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.